Everyone, it's Matt Donaghue and Ken Hamilton with Alan Zhang from Kestra Investment Management. We are here today to talk through the markets. This is meant to be a Q2, maybe early Q2 market update for everyone. We know it's been a very, very interesting start to the year so far. So we're really pleased to have Alan with us today. Just as a quick introduction, again, we're Mission Financial Planners. Ken and I are two of the managing members here. We're based in San Antonio, Texas, but we do work with clients in 38 states. So if you're watching this on our YouTube channel, if you're checking this out on LinkedIn or something like that, feel free to reach out to us. You can always get a hold of us at 888-339-0093. Once again, 888-339-0093. You can also email us at admin@mfplanners.com. And by the way, MF stands for Mission Financial. It does not stand for what some people think MF stands for. So Mission Financial Planners, admin@mfplanners.com. But with that, again, I'm Matt Donaghue, Ken Hamilton, Alan Zhang. Ken, take it away.
Sure. So the last couple of months have been anything but boring, and there's a lot to cover, a lot to explore. Alan, thank you so much for your time this morning.
For sure.
So, Alan Zhang, are we expecting rate cuts this year, and how are we positioned if that happens or if it doesn't?
Yeah. So that question, like the answer to that question is shifting by the minute. So we are closely monitoring, the expectation of Fed rate cuts, and that number has shifted significantly, given what happened in the last few weeks. So Fed has two main mandates, right? So they want to control inflation and they want to increase employment. And the inflation number is that, is the metric that is being impacted the most right now. And Fed was, on the path to do 1 to 2 more rate cuts on 2025. But the thing is, if this tariff war continues and we see, inflation pressure coming out of these tariff policies, it's a possibility that there could be a pause or a smaller number of cuts. So we are monitoring those very closely, and we believe Fed will be very data dependent. So every month, the new economic data comes out, they will probably make a decision. So it is something that we are monitoring and adjusting in our portfolios. And right now, I believe we are positioned with a well-diversified portfolio, which we kind of traded in March, expecting heightened volatility, which we, I guess, didn't expect that much volatility that will happen in early April. But we did position our portfolios to be more defensive, to be more international, more value-oriented.
Okay. So, Alan, not to interrupt you, Ken, but Alan, I think you kind of said a key word there: inflation. So, with the on again, off again tariff policy, I mean, economists seem to be lined up pretty strongly that, hey, if tariffs are really implemented, closer to what was originally attempted to be implemented, we're looking at some serious inflation issues. But even if the scaled back version, the 10% tariff with 25% on certain other industries or countries, shutting off China basically with the 245% tariff and all that.
Yeah.
What is the expectation? And I know you said you're monitoring rate cuts on a day-to-day basis. Is it much of a different story with inflation as well from a portfolio manager's perspective, or what are your thoughts on inflation?
So there has been a lot of estimates that came out, right? And some are estimating that the inflation, the PC metric could go back to like the 4 to 5% level. But again, like tariffs, these are easy to put on, but also easy to take down. So that has been a message that we are trying to convey with our clients, which is that there is a 90-day pause now, and they are doing active negotiation behind the scene with all the countries. And I think just this morning, China came out, expressing some willingness to talk, given their conditions. So there are conversations that are happening that could possibly remove or at least reduce a lot of the tariffs. So again, like with the policy change, right, that would change our inflation outlook. But in general, tariffs are believed by economists and by people in the investment community to be inflationary pressures, right? So it is a matter of there's exporters from other countries and importers in the U.S. and then the end consumers. The three parties would sort of work not together, but the market dynamic will sort of divide the price of tariffs among these three parties. If the importers in the U.S., such as Walmart, has a lot of negotiation powers, they can theoretically pass a lot of the tariff cost to the exporter in other countries, and basically through large-scale negotiations to request the exporters to reduce their cost. So the inflation, the tariff will be sort of eaten mostly by these exporters. That will translate into a much smaller inflation impact domestically in the US. However, if the tables are turned when the importers have a weaker negotiation hand and they are less willing to basically decrease their margin, right? They're less willing to eat that cost, then we might see more of those tariffs being passed on to the consumer through price increase or shrinkflation, if you will. So it's a dynamic among these three parties, and different industries will be impacted differently. And yeah, but overall, we would expect inflation to go up in the short term if tariffs are not scaled back or reduced.
Yeah, and this is a real thing too. So there was a article this morning that was talking about inventories on U.S. auto dealerships and
Sure.
how
Yeah.
the normal inventory range is 90 to 100 days. And just with the increased buying of people trying to get a vehicle before prices go up, which is what
Yeah.
people are expecting, the inventories are now down to 70 days. And so, when I read that, it made me think of 2020, right?
Yeah.
2021 all over again, when especially used car prices went through the roof, because people, were buying cars, right?
Right.
So I think for people who say it's not necessarily, I'm not worried about tariffs. I think that, would you say it's fair to say you should be concerned about tariffs? Because there is a real impact to this. It's not just,
Yeah.
hey, you're not, buying, little stuff that's going to be more expensive. It affects big ticket items too.
Yeah. So what I will comment there is that we use this example of coffee, right? So coffee is what I like. There are people who probably love coffees. I drink at least one cup. Okay, perfect. I drink at least one cup every day.
Right.
And there are people who would go to Starbucks or some local coffee shop to get their coffee too, right? So when you think about like coffees, most of the coffee beans are are imported into the United States, just simply because climate wise and all that, U.S. doesn't really grow coffee beans. So all of those imports, if are hit by a tariff, could slightly increase the coffee bean prices. But throughout that whole process, right, from the import of the coffee bean to you get served a cup of coffee at Starbucks, the biggest price increase might be like the plastic, the cup, or the cap that are associated with this. All of those are most likely to be imported from China. The plastic bags that you see in grocery stores, around the vegetables and the fruits, those are most likely being imported from China. You buy a cookie from the supermarkets, the packaging most likely coming from China. So even though like a lot of these products could be like, let's say, manufactured or produced within the United States, but a lot of the surrounding um, supplements, if you will, are coming from other countries. And when we look at that coffee example, the biggest price increase actually comes from that plastic cup in price increase. So I mean, and it's hard to sort of just simply turn off the switch and then expect to get the capacity elsewhere, because there are no other countries right now that can manufacture those items at a large scale and at affordable, low, reasonable prices. So those are some of the sort of the indirect, inflation or tariff impact that you can see in your day-to-day life.
Sure. So Larry Fink from BlackRock, you know, put out his annual thing he does, and he's been actually quite active lately in
Yeah.
the news and social media and everything. And he's talking about, instead of 60-40, it should be 50-30-20.
Right.
And the three of us know what that means, but just for everybody else out there, the 60-40 was kind of the standard portfolio for the moderate investor: 60% stocks, 40% bonds. In our parlance, it's 60% equities, 40% fixed income. But the 50-30-20, the idea there is it's 50% stocks, 30% in bonds, 20% in alternatives. Kim has done a lot of work with liquid alternatives and some alternative income strategies and so on and so forth.
Yeah.
What alternative assets or income strategies is Kim really positive about right now, just in terms of either A, balancing out portfolio volatility,
Mm-hmm.
or B, balancing out income volatility for the person who's taking income from their portfolio?
Yeah, for sure. So one thing that we've always liked is liquid, under the liquid alternative sleeve. So trend following strategies. So trend following strategies, if you hold them long term, when I say long term, I'm talking about like 10, 20 years as a sleeve in your portfolio, right? Call it 10%, 20%. There is a, empirical evidence that it can help your portfolio to, manage the volatility. It helps through a reduction of drawdown. So when '08 hits, when 2020 hits, right, having trend following strategies in your portfolio would help protect your downside. So over a long time period, it will be able to help you, likely to increase your risk adjusted return. So, the thing with trend following strategy is that it only works about 30% of the time. 70% of the time, it will probably lag the S&P, for example, right? So if S&P is up like 20%, the trend following strategies might not be up as much. But where it really shines is the 30% when market is not doing that well. So we like trend following strategies as a sleeve of your portfolio. It shouldn't be the entire portfolio, but 5, 10%, 20% allocation to that makes sense to us. The hard part is how do you sort of have the conviction, right? To have the conviction to hold them long term. In terms of kind of what Larry Fink and BlackRock, those folks are talking about, right? A lot of them are thinking about like infrastructure. And for infrastructure, right, if a lot of the policies right now are being implemented, United States needs a lot of critical infrastructure to be built, right? Data centers, highways, different plants. So there are some long-term, I think, opportunities there. And historically, these private investments or alternatives have had high bars of entry, right? You need to be accredited investors, you need to meet certain minimums. But over the past few years, like the industry trend is moving towards that. They're trying to make these investments more accessible to the everyday people, right, and to the regular, the retail investors, if you will. So the minimums are lower, the access has been loosened, so there are more opportunities for people, to invest in those now. So that which makes the 50, 30, and 20 portfolio a much more likely scenario than call it like 10, 15 years ago.
Okay. Well, great. Now, again, we're talking about alternatives as a way to minimize volatility and things to that effect. And traditionally, bonds have fit that role. When it comes to bonds, again, they're directly related to interest rates, whether they go up or down. And I can't remember of a time where I've ever seen where it could go either way, right? And correct me where I get this wrong, Alan, is if inflation goes off the rails again, they might increase interest rates further. But conversely, if unemployment starts skyrocketing and the market gets more volatile, they might cut rates. So thinking about that, because bonds are supposed to provide security for your stocks, and that's where alternatives have kind of started to shine. But bonds are also supposed to generate income that you use to reinvest or to live off of. So thinking about bonds and fixed income, How is Kim thinking about duration in their fixed income portfolios, given the current yield curve and the Fed outlook, and really just how the coin might flip?
Yeah. So in the last round of trading that we did back in March, we made some position changes within the fixed income portfolio. So what we did is that we reduced our duration slightly. So we favored shorter duration bonds, and we also favored higher quality investment grade bonds. So we see some opportunities on the investment grade corporate side, and we position our duration to be slightly shorter, mostly just given the curve of the yield curve, and also we were expecting volatility and uncertainty in the treasury market. So things like well, after Liberation Day, right after the tariff plan was announced, there were a few days of extreme volatility. Right, markets was down and up. So the day when it was announced, the 90-day pause, right? That was when like Treasury, the yield curve like shot up significantly, right? We saw probably one of the biggest move like in the past like decades, and many believe that was the sort of the concerning data point that forced the administration to pull the trigger, right, on the 90-day pause. So times like this, right? I mean, we still like our position on the shorter end. When I say shorter end, our entire portfolio, right, it's still managed relative to a bond benchmark, right? So the shorter will be relative to whatever that benchmark is, and we are staying slightly on the lower end, and we are doing that through a combination of a barbell approach, so short end and long end. And then overall, the portfolio is we believe that we are more defensively positioned now.
And so you mentioned a key word I want to dig in on, and that was higher quality. Now, 2008, that the financial crisis was mostly led to poor financials of a lot of those companies. At least everything I've read, and again, maybe I got some parts wrong and you'll correct me, but really since then, the balance sheets of a lot of companies are a lot more stacked and protected than they were 15, 20 years ago, which is crazy to think it was that long ago, but 15 to 20 years ago. And so while you're going to higher quality, is that because, again, there'll be less volatility if and when a recession happens, or if a recession does come, again, some of the companies we know and love might not be around anymore because their balance sheets are not as good as, they could have been.
Yeah. So when I say higher quality, I'm referring to like, AAA rated, right? Securities and companies. So the main reason why we favor that is, when you are thinking about taking risk, right? If you want to get additional return or additional yield, you need to take a little bit more risk. And the credit risk is a very important component in the fixed income sleeve. And there's this curve that we monitor called the credit spread or the high yield spread, right? The high yield will traditionally be considered as the junk bond, and that spread has been quite tight, meaning that it doesn't actually pay you that much more by taking on those additional risk. So in that environment, right, you are moving from, let's say, AAA to like a double B, kind of much lower quality company, but then you are not getting that much additional yield, right? That trade-off doesn't make sense to us.
Right.
However, we are seeing some widening of those spreads. So now, high yield corporates, they are paying more than before, than like 2-3 weeks before, to take on those additional risk. But they're still not at the level where we find the trade-off to be attractive or convincing yet. So that's why we position our fixed income portfolio to be more high quality.
Great, thank you. Matt, what's the next question coming up?
Well, Ken, I think you had a follow-up to that too, about big market events coming up later in the year that we might be watching.
Yeah, I guess, are there key economic events that you're specifically looking for? I'll tell you the one I'm watching most closely, and that's unemployment, because the second that one spikes, again, most bets are off. Like that's the one that I would hope that the everybody focuses around getting back in line. But what are
Yeah.
some of the things y'all are watching?
So, I mean, unemployment is definitely one, right? And even though, like right now, we always say that the economic data points have been robust, and they have been. Uh, we need to look forward, right? How, like, kind of speculate or estimate how these tariffs policies, if they were capped for 90 days, 180 days, like how will those play out, right? A few key things that we are monitoring is, one, are these tariffs impacting sort of the profitability of U.S. corporations, right? So that's one. And second, a lot of the investment activities or capital expenditures of these corporations, they are basically put on pause because of the uncertainties around the policies, right? It's extremely hard for a corporation to commit capital to invest in the United States and build a plant that might take multi-year, or even a decade to be built up, committing hundreds of millions and billions of dollars if, let's say, the tariff could be theoretically taken off, and then that plant becomes uncompetitive again. So two things. One, whether the corporate profits or the bottom line would be impacted. And second, how are companies investing given this uncertainty around policies? So those are two things are more on the corporate side. And then lastly, the one thing that we are closely monitoring is how inflation will be impacted by tariffs. And we would like to see some estimations and all that. And we do see some, uptick, but that's more like sentiment wise, right? So University of Michigan, they have this inflation expectation index, and that shot to the roof last Friday. But that's again on the estimation, the sentiment side, not the actual data yet.
Okay.
So there's a lot going on right now, right? You guys
Yes.
are watching a lot of things. There's
Yeah.
a lot of noise. You kind of chuckled when I brought up Larry Fink, right? I mean, everyone's talking right now, right?
Yeah.
With all that noise, with all that, commentary that's happening right now, what are some of the underappreciated or maybe just risks, but also maybe opportunities that people just aren't paying attention to right now?
Yes. I think, with all these noise, right? The message we've been trying to convey has always been, that if you have a diversified, well-structured portfolio that have, different exposures to various asset classes, and that, it is, you should hang on to that. And like one great example is, after the tariffs announced, Thursday and Friday, market tanked. However, on Wednesday, there's a 90-day pause and the market shot up 10%.
Mm-hmm.
So let's say, someone panicked and then sold everything. It's very hard for you to time it so perfectly, and then you got right back in on Tuesday to get that 10% jump, right? And we can share some charts and tables later, right? If you miss some of those big moves, like the 10% jump, over time, that will significantly impact the investment returns that you will have. And another piece of data point that I always like to share is that over the last 100 years, so this is from Professor Jeremy Siegel, and they were able to basically capture the data of returns for stocks, bonds, cash, gold, and the dollar since 1800. So it's actually the past 200 years of return. What has been the most consistent
Ooh,
asset class?
I know, I
Yeah,
know. Stocks, right?
it
Equities,
is
right?
stocks, and stocks has delivered on
Right,
average, right? 8 to 9% of return, right,
right.
over that time period. Uh, that has been the most consistent wealth generator. Um, so yeah, so I mean, I think the underappreciated fact is, having having the mindset to remain committed, right? To have a diversified portfolio and then keep investing, keep timing the market versus timing the market, which
Right.
the latter has been sort of proven to be extremely hard to do, and often will detract from your goal and from your long-term, return over a period of time.
Yeah, and you're singing our song. We'll share with everybody as well. This will get pushed out in social media and emails as
Yeah.
well. But we'll share some of those pieces Kim has put out on staying invested, not trying to time the market, missing the best days in the market, those kinds of things. Because you're absolutely right, and it's something that we talk about with our clients all the time, to the point where we even tell prospects, look, if you're looking for a financial advisor who's going to trade on a daily basis, we're not your guys. We're not, because we believe in a well-diversified portfolio. If you look at the books on my shelf right there, there's Jeremy Siegel right there. There's Benjamin Graham right there, the intelligent investor, right? We strongly believe in a buy and hold. Do not try to time the market. When you hit your financial goal, that's when it's time to make a change to something. It's not
Right.
because of what is happening in the short term. And we have our client event coming up tomorrow night where Kara, and John are going to come out, and they're going to hear that from me as well. If you just think about the last 5 years, nobody's talking about COVID anymore, right?
Yeah.
COVID is still out there. COVID is a distant memory, right, at this point. And when you look at some of the sell-offs that happened in COVID, they were worse than what happened this year, right? So the people who got out and panicked, though, they really made a bad mistake. Same thing for the people who got out in 23 when the Fed started raising interest rates, 23 when the Fed, 22, excuse
22,
me,
yeah.
when the Fed started raising interest rates and crushed bond returns for a year, and the market had a bad year, right? We could go on and on and on. These are all things that happen. The person who comes out on top every time is the person who stays invested every time.
Yeah.
So thank you for reinforcing that. We that's one of the reasons we like working with you and like working with the team at Kim. Before we wrap it up, Ken, any last questions, comments from you?
Comments really is, this is why we're here. We're here to provide information, to hold your hand in the scary times and high five in the good times. So for our existing clients that are watching this, let's talk. Let's review it. We'll walk you through, explain how and why the movements have happened and what to expect coming next. If you are meeting us for the first time, let's chat. Let's take a look at where you are, where you want to be, and if your assets are in alignment with your beliefs and your values, and that they will get you to where you want to be the way that you want to get there. There's many ways, and we're very confident, but we're also humble enough to know that we don't do it all. That's why Alan, that's where Kim, that's where our other investment providers are huge resources for all of us. So right. Let's talk, and excited to have that conversation.
All right, great. Well, Alan, thank you again so much for your time. Any final thoughts?
No, I mean, I think you already made a great conclusion, right? Remain invested, keep a diversified portfolio to ride through this volatile times.
Great. Well, thanks again, everyone. And for those of you who are watching, feel free to reach out to us if you do have any questions. You can send us an email at admin@mfplanners.com. Once again, admin@mfplanners.com, or feel free to give us a call at 888-339-0093. Once again, 888-339-0093. And for those of you in South Texas, it is fiesta time. So hopefully we'll see a bunch of you tomorrow night at our client event, where we'll have more people from the team at Kim speaking with our clients. But thank you again, everyone. Have a great rest of your week.